Antique Stock Broking, I would like to welcome all the participants in the earnings call of Raymond Ltd. I have with me Mr. J. Mukund, who is the head of Investor Relations of Raymond Ltd. Without taking further time, I would like to hand over the call to Mr. Mukund. Over to Mr. Mukund.
Thank you, Abhijit. Good evening, everyone, and thank you for joining us for Q4FY18 earnings conference call. I hope all of you would have received the copy of our results presentation. I would kindly urge you to go through this along with the disclaimer slides. We have with us today Mr. Sanjay Bahal, our Group CFO, Mr. Sanjay Bahal, CEO of Lifestyle Business, Mr. Vipin Agarwal, President Corporate, and Mr. Vivek Agarwala, CFO of Lifestyle Business. I will now hand over the call to our Group CFO, who will give you the summary of the results before we open up for Q&A. Over to you, Sanjay.
Thank you, Mukund, and good evening, ladies and gentlemen. Thank you for joining us today on this earnings call to discuss the results for Q4 financial year 18 and for the full year financial year 2017 and 18. I'm happy to share that the year has been a defining year for us. We have strongly recovered from the impact of two structural reforms which impacted the entire economy, the cash crunch due to demonetization and the GST implementation. This year has seen the successful execution of our strategic drivers in each of the businesses which have been focused on profitable growth and value creation. The key highlights. Overall, at the consolidated level for the full year, our revenues clocked 6,025 crores, a growth of 9% and 13% if we exclude the GST accounting impact. The EBITDA increased by 29% to rupees 546 crores and EBITDA margins improved by 140 basis points to 9.1%. Underlying PAT delivery was 115 crores, which is higher by 259% as compared to last year. Reported PAT was 135 crores, which is significantly higher than the last year PAT of 26 crores. Consequently, our ROC at consolidated level increased by over 200 basis points at 9.2%, excluding the investment in real estate land development cost. From guidance perspective, our revenue growth performance has been ahead of the high single-digit growth guidance given earlier, and the EBITDA margin improvement by 140 basis points is in line with the guidance given of 100 to 150 basis points improvement. A quick overview of the quarter. The overall revenues grew by 14%, excluding the GST impact, with total revenues coming to 1655 crores. The EBITDA increased by 21% to rupees 176 crores and EBITDA margins increased by 100 basis points to 10.6%. A PAT increased from rupees 33 crores to rupees 53 crores, an increase of 61%. The year witnessed growth across all our segments. Now coming to specific segments, our branded textiles registered a strong sales growth of 10%, excluding GST impact, and this was largely driven by the wholesale channel bounce back coupled with emergence of institutional sales as a strong category. The robust performance of Techno Series portfolio in branded textile segment continued with the introduction of Techno Stretch and Techno Fresh products, which resulted in over 2 million meters of Techno Series fabric sales, a 30% growth over last year.
Just one second. Just want to reconfirm if people are connected on the call. Hello. Just want to check if you can take note that people are all connected on the call, or is there a
sorry to interrupt. This is the conference operator. Sir, we have all the people already connected to the conference. So whoever's dialed in, they are all taken to the call yet.
Okay, fine. That's good.
Thank you. You may please continue.
Okay. To continue, the growth momentum in B2C shirting was maintained, led by high consumer demand and deeper market penetration in the wholesale and TRS channels. The branded apparel segment maintained its strong revenue growth momentum of 19%, led by growth across all 4 power brands. The focus has been on enhancing the core proposition as a full wardrobe solution provider across our power brands. The branded apparel portfolio has now been strengthened by entering new categories through 2 new consumer segments. we launched Ethnic's product offerings in the high-growth ethnic wear segment. It is being positioned as a premium, stylized, elegant offering and will be progressively available in TRS Select MBOs and LFS channels. We also launched Next Look range of product offerings positioned as superior quality with aspirational designs, specifically targeted at the value segment, and this will leverage the opportunity in the space as we see consumers transition to branded apparel from unbranded apparel. This will be progressively made available in our existing strong distribution network and ready retail presence in over 400 towns. Also, we recently partnered with KVIC and have launched India's first branded Khadi label, Khadi by Raymond. We are promoting Khadi as a fashion fabric and will be retailing through Raymond ready-to-wear EBOs, Select MBOs and TRS network. This year we opened 139 exclusive brand stores at the net level. About 75% of the stores opened were on franchise basis. This was led by rapid expansion of our retail network in over 70 towns through 91 mini TRS stores. Mini TRS is an exciting innovation of the year in the retail store format, and this is an asset-light 100% franchise format store which is being opened mainly in 4 to 6-tier towns. We enhanced the capability and the capacity of the tailoring ecosystem during the year by creating a conversion capacity of over 1 million meters of fabric through opening of 25 franchise-based hubs and enhanced the capabilities of the tailors by training about 20,000 tailors across India in 15 states. This is helping us in facilitating superior custom tailoring services to the consumers through improving the quality of the infrastructure and upgrading the skill set of tailors. In our B2B businesses, the Ethiopian operations are being stabilized and we commissioned the greenfield linen plant at Amravati with a capacity of 4 million meters. The Ethiopian plant will meet the increasing global demand in US and Europe in a garmenting business, while the Amravati plant will largely cater to a captive consumption requirement of high-quality linen portfolio. In our engineering businesses, in the tools and hardware business, the successful turnaround strategy of building operational efficiency and product rationalization has enabled significantly improving EBITDA margins to 9% from 2% in the previous year. The auto component business profitable growth momentum continued with EBITDA increasing by 90% to rupees 45 crore in financial year 18. Let's take a brief look at the free cash flows. Our free cash flow for the quarter was...
excuse me, sir. This is the operator. Sir, may I please request you to just hold the line for about 2 minutes as we have people coming in. So if you can just... you can just continue probably after 2 minutes. If you can just...
Okay, you give us a cue to continue.
Sure. Thank you very much. Participants, please stay connected while we have the management reconnected. Ladies and gentlemen, this conference call is delayed by 5 minutes. You may please stay connected while we start the conference again. Please stay connected. Please do not disconnect your lines. We will start with this conference again. Thank you very much. Ladies and gentlemen, thank you for patiently holding the line. Well, we have recirculated a new number to the participants who cannot connect to the conference. So I would request all the participants who are already connected to the call, continue to stay connected on this conference. We will start with this call shortly. Requesting all the participants who are there in the conference, please stay connected. Please do not disconnect your lines. We have some more participants joining the conference, so we will start the conference shortly. Please stay connected. Thank you very much. Ladies and gentlemen, thank you for patiently holding the line. We have the management back to the conference. Sir, you may please start now.
Okay, so I stopped at the point where we had come to the cash flows. So let's begin with that. Our free cash flow for the quarter was positive at 88 crores, led by EBITDA improvement and positive changes in working capital. Our operating cash flows for the year was positive at 519 crores. However, due to capex on account of setting up of Ethiopia and Amravati plants and interest costs, the free cash flow was negative during the year at rupees 201 crores. Gross debt stood at rupees 2,353 crores as on 31st March 2018 versus 2,140 crores last year, and the net debt position was rupees 1,894 crores as of 31st March 18 versus rupees 1,682 crores last year. Our net debt levels increased this year mainly due to manufacturing capex in Ethiopia and Amravati plants. Net debt to equity remains stable at 1.0. The average interest cost has reduced by 50 basis points to 7.8%. On the working capital front, the net working capital days improved by 10 days from 99 days in March 2017 to 89 days in March 2018, largely due to efficient working capital management. Coming to capex, the capex spend was rupees 409 crores in the year, mainly comprising of rupees 127 crores for Amravati, 62 crores for Ethiopia plant, and 42 crores for stores renovation and rollout, and the balance for regular maintenance capex. Now coming to specifically to the quarter 4 highlights. The performance for quarter 4 is on track with the growth momentum being maintained. The quarter witnessed a growth across all segments. Our revenue was at rupees 1655 crores, grew by 10%. However, excluding the GST impact, it grew by 14% and EBITDA margin improved by 200 basis points from 8.6% in quarter 3 financial year 18 to 10.6% in quarter 4 financial year 18, which are in line with the guidance given in the last quarter. Now let me discuss briefly the performance of each business segment. A branded textiles segment sale was rupees 802 crores, higher by 9% on year-on-year basis. However, excluding the GST impact, it was up by 13%, led by 8% growth in suitings business and 36% in the shirting business. The growth in domestic markets was led by the wedding season and growth in trade channels and institutional business. EBITDA margins improved from 17% to 19.5% as compared to the previous year, largely driven by the strong sales growth. A branded apparel segment's top line was rupees 403 crores and it grew by 12% over the previous year, and after accounting for the GST impact, the like-for-like basis, it was 20% growth, primarily led by consumer demand during the wedding season and the extended end-of-season sale period. The overall growth of the brands for the full year were, and this excludes the GST accounting impact, Park Avenue 7%, Raymond Ready-to-Wear 33%, Color Plus was at 10%, and Parks was at 35%. The new product offerings of Ethnics and Next Look also contributed to the overall growth. Our major channel sales growth on a full year basis was as follows. The TRS grew by 11%, MBOs by 48%, EBOs by 13%, and LFS by 8% as compared to the previous year. EBITDA margins improved to 3.7% from negative 3% in the previous year, and this was mainly driven by higher sales and lower discretionary spends. Coming to our retail channel, our exclusive network stood at 1,219 stores. Sales in quarter 4 across the exclusive network grew by 15.5%, led largely by the wedding season and the end of sales period. During the quarter, we opened 70 stores and closed 12 stores. 12 store renovations were completed in quarter 4. Currently, 25 stores are under renovation. The average same-store sales growth for the renovated store has been 17% for the full year. We opened 91 mini TRS and 2 exclusive MBOs through the franchisee route, which was in line with our stated strategy of expanding the network through an asset-light model. In the garmenting business, sales was rupees 201 crores and grew by 9% over the previous year, led by sales in North America. The EBITDA margin was stable at 6.9%. The luxury cotton shirting fabric segment sales at rupees 145 crores grew by 37%. However, growth was without the GST impact was higher at 39% and largely driven by better offtake by the customers. However, the EBITDA margins were lower at 9.1% as compared to 9.5% in the previous year, mainly on account of change in the product mix. The tools and hardware segment sales was at 90 crores, marginally lower over the previous year. However, growth without GST impact was 4%, driven by better performance in the domestic market. The turnaround strategy of building operational efficiency and product rationalization helped in significantly improving EBITDA margins to 9.9% in the quarter as compared to 2.3% in the previous year. Auto component segment sales was at 62 crores, significantly higher by 50% over the previous year. Growth excluding the GST impact was 56%, driven by increased demand from passenger vehicle, commercial vehicle and industrial segments. In line with the sales growth, EBITDA has also grown by 50% to rupees 9 crores. Overall, the business is maintaining its profitable sales growth momentum. Coming to CapEx, the CapEx spends was rupees 92 crores in the fourth quarter. Now, coming to some guidance for the full year 18-19. We expect economic outlook to remain positive, underpinned by private consumption and public investment. We believe the shift from unorganized to organized segment post-GST in the semi-urban and rural areas and improving consumer sentiments to be the key drivers for the consumption market. For the financial year 2018-19, we are expecting growth momentum to continue in the branded textile segment with a continuous focus on product innovations supported by service innovations in tailoring services and the rapid retail network expansion through mini TRS, which will continue in semi-urban and rural areas. In the branded apparel segment, there will be continued focus on strengthening the brand and the core proposition of becoming the complete wardrobe solution provider along with channel expansion. It will be well supported by driving category expansion, including the recently introduced Khadi portfolio and building scale of the new product offerings, Raymond Ethnics and Next Look. In the B2B businesses, we expect the Ethiopian and Amravati operations to stabilize progressively through the year and cater to the increased global garmenting demand and domestic linen fabric demand respectively. In the engineering businesses, the business transformation in tools and hardware segment is expected to continue. In the auto components segment, we achieved consistent strong performance in financial year 18. The business turnaround is now complete and the capacity is under full utilization. The business has witnessed strong growth of 36% over the last year. The growth is across all segments and hence the capacity is now planned to be enhanced by 3 million in ring gears and flex plates to meet the increased demand. Hence, we will be investing rupees 48 crores to augment the capacity. This is in line with the stated strategy of enhancing value creation in the long term. I am happy to share that our board has approved real estate development of 20 acres for residential purposes. This approval paves the way for Raymond to monetize the assets. The project is expected to be developed over a period of 5 to 6 years. The estimated project expenditure for financial year 18-19 will be in the range of around rupees 300 crores. The company has secured major regulatory approvals and other construction-related approvals are in process. From a full-year guidance perspective, we expect revenue growth to be in the range of high single digits and EBITDA margin to reach double digits. In the annual investor meet in July 2017, we had given a 3-year revenue guidance till financial year 20, which included a 7 to 9% growth in financial year 18 and a 10 to 12% through financial year 20 and an ROC of 12 to 15% by financial year 20. We are still committed to achieve our overall financial year 20 guidance numbers. Now coming to our CapEx guidance for financial year 19, we have already stated that the peak CapEx is over in financial year 18. Going forward, the annual CapEx is expected to be in the range of rupees 200 to 250 crores, largely driven by retail expansion, new stores and renovation and maintenance CapEx. Overall, the challenges include continuous discounting in apparel industry, which will moderate margins, increase in oil prices, which will increase the input costs. Currency fluctuations and rupee depreciation will have a positive impact on our export businesses. Now coming to specifically to quarter 1 of this year, we expect moderate consumer demand due to seasonality factor and low wedding dates in Q1 financial year 18-19. This will impact our suiting textile business. However, the branded apparel business is expected to maintain its double-digit growth momentum. At a consolidated level, we are expecting mid-single-digit revenue growth over previous year. We expect to maintain our EBITDA margins. However, due to commissioning of Ethiopia garmenting and Amravati linen plant, our depreciation and interest costs will be higher by rupees 11 crores as compared to last year, and this will impact the profitability for Q1 as compared to previous year. The capex guidance for Q1 would be around rupees 65 crores, mainly related to retail expansion, new stores, auto component capacity expansion, and the remaining for maintenance capex. With that, this ends the commentary for Q4, and now I will open the floor for questions. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question-answer session. Anyone who wishes to ask a question, you may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. A reminder to the participants, if you have a question, please press star and 1 at this time. We take the first question from the line of Dikshit Mittal from Shubham Ventures. Please go ahead.
Yeah, hi sir. Congratulations on good set of numbers. So my question firstly is on this real estate development. So can you give what is the FSI that will be available and what can be the kind of square feet that will be developed over the next 5-6 years?
Okay, so as I mentioned that the overall what we have is a clearance from the board to develop 20 acres of land for residential purposes. Now, there has been some guidance and suggestions from the board on the specific project plans. Now, this is under finalization and is still work in progress. So we should be coming shortly to you with the specific details. Right now, the real estate team is working out the specific project plan. So it's still WIP at this stage, so I'm unable to share specific details on FSI. However, the broad contours of the project have been shared. It's 20 acres, roughly around 3 million square feet of saleable space, which will be, over a period of 5 to 6 years is when the project will be executed. Those are the broad contours, really, of the project at this stage, which we can share with you.
Okay. So secondly, in this quarter, you have taken 105 crore towards the cost towards property development. So in the segmental, sir, can you give the breakup, like where have you apportioned this cost in the segmental results?
Yeah, so this is really being carried in the inventory as stock in trade. Specific to the segments, it is in other segment, right?
It is in other.
It's in the other segment.
It's no impact. Yeah. Oh, but if I see, sir, others, it's closer to around 80 crores, right? In terms of if I see segmental results in others,
it's not impacting the P&L. Because this 105 crores is the investment that we have made towards the project. So it's land development project expenses. So it's not a cost to the P&L. So this is being carried as has been inventorized as a WIP as far as the project is concerned.
Okay, sir. And sir, coming to your guidance for next year, you have mentioned around high single-digit growth. So will it be driven by this textile and apparel, or what is the driver for this growth?
Yes, as I mentioned, in the speech, that will be driven by branded textile and branded apparel. Branded apparel will continue to be driven by high double-digit growth as we have maintained over the past 8 to 9 quarters. So that growth momentum will continue. Branded textile, which is suiting and shirting, will also, at a blended level, will be driven by high single-digit revenue growth.
Okay. And sir, lastly, how will you be financing this development of real estate? Will you be taking debt or...
So what we have indicated is for financial year 18-19, the 300 crores that we have projected is going to be funded largely by debt, but specific plans on financing, on the total project schedule and timelines will be specifically shared later.
Oh, thank you, sir.
Thank you. Before we take the next question, I would like to remind all the participants, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up. Thank you. We take the next question from the line of Sagar Kalkraj from Motilal Oswal. Please go ahead.
Hello.
Yes, please go ahead.
Yeah. Thank you for this opportunity and congratulations on good set of numbers. 3 things. One is on the Park Avenue in our branded apparel is seeing just a 7% growth. So any extra efforts that we are likely to take to see a further growth in that brand in the next year?
Okay, so Park Avenue is actually the largest brand in our apparel portfolio. So while the overall growth looks 7% in terms of absolute crores, it's added almost, in more than what, the higher growth brands have, percentages wise, have added. So one is the base effect. The second thing, your question is still valid, that in a market which is growing at about 8 to 10%, this brand has a potential to go 1.5 times the market. So clearly, the brand has been having a momentum over the last 3 years of a strong double-digit growth. The work that currently we are doing is repositioning this brand, and that's why you see some level of modest growth coming onto this brand, wherein we are reclassifying the entire product segmentation from formal and a little bit of casual, which was Park Avenue dress casual, which was 20% of the portfolio and 80% was categorized as formals. We have completely changed the overall segmentation to become work, play and celebrate. So as the lines between casual and formal are blurring in consumer world, and as the dresses are getting into these 3 segments of workwear, which could actually mean a lot of casual wear getting into the workwear. So you can actually do a jacket and a denims for work. So that is one segment. Play is another segment and celebrate. So as we are moving from the conventional old segmentation to new segmentation, there is one impact of that you will see of some level of impact on the growth as we go forward. The second investment we are making is changing the face of retail. So if you see the overall aggression that we've had or scale up that we've had on Raymond Shop is far outstripped any other brand in terms of rollout. Because we wanted to last about 2 to 3 quarters, we have been working on fixing the identity, the new identity of Park Avenue brand, which is far more contemporary, far more in sync with today's times. And we have just last week opened the 100th store, 100th store of Park Avenue. But this also is the store which sets the tone of how the new Park Avenue retail experience for the future stores is going to be. So that has taken us some 2 to 3 quarters, and that is now behind us. Last week we've kind of inaugurated the store, and this will set so with the new product segmentation, new product identity, and new retail, these 3 efforts are going to go. But you will need another 2 or 3 quarters before it starts getting into strong growth. So I would say as the retail stabilizes and the product stabilizes in the market, I would say another year of this kind of a growth, and then we will start seeing a rapid propulsion to this growth. It'll start moving up.
Right, thanks, useful. And secondly, on the Raymond Blacks, we saw a lot of marketing around that. So how has been the response, if you could share something on that?
Response has been ecstatic. In fact, when a customer wants a black, what Raymond offers is over 800 SKUs of black. And that really is the widest range of black. So that one is the range of black that we were able to offer. The second is the quality of black, because black also needs to be the ranges between grayish black to coal black to ash black to really truly black. Yeah. So the whole gradation, SKUs, designs that we offered were over 800 SKUs when we launched the campaign 2 months back in Q4. And overall black anyway is the single biggest segment to our overall textile fabric, suiting sales especially. And that, you've seen the results. We've had a double-digit growth in Q4 in suiting business. In fact, domestic has grown a little higher than 10%. And from a CAGR of about 3 to 4% for suiting volume domestic over the last 3 or 4 years, in the last year recording 10% accelerating in Q4 is a reflection of the success of multiple campaigns. One is black. The second is the success of Techno series, which has grown by 30% last year in suiting fabric. So our innovations are started taking over very high level of growth in the market.
Right. And lastly, on this 105 crores of item which we have expensed in the P&L, is it largely cost of salaries and architects fees, etc., or is it some municipal authorities fees, fungible FSI premium or something like that, if you could shed some light?
So you're referring to the 105 crores which is shown there?
Yeah.
Right. So that 105 crores is largely the approval, cost of securing the regulatory approval. So we've got ULC approval and we have the other local construction related approval. So that is the 105 crores really. The other costs pertaining to the overhead, etc., has gone into the respective, expenses.
All right. Thank you. I'll come back in the queue. Thanks.
Thank you. We take the next question from the line of Abhishek Roy from Stewart and Mackintosh.
Hello. Good evening, sir, and congratulations on good set of numbers. And, sir, I just have one question regarding that 100 crore non-convertible debentures that you are planning to raise. So can you just tell me what is this about and what is the purpose and what will be the payment period and everything? Can you just throw some light?
Yeah, so the NCD issue that we have taken was for general working capital purposes. Also, it was a part of that was also used for the approvals that we have taken for the real estate project as well.
Okay. And, sir, regarding this capex that you have projected around 250 crores for FY19, so this will be fully funded through internal accruals or anything will be there in the debt?
Largely through internal accruals.
Okay. And this interest rate is around 7.8%. That's
right.
Okay. Thank you, sir. That's all from my end.
Thank you. We take the next question from the line of Nihar Jain from Edelweiss. Please go ahead.
Hi, sir. Good evening, and first of all, congratulations for the great set of numbers. So, my first question is on the branded apparel side. You mentioned that there was EOSS which continued into Q4 also. So, till when was it that this continued? Was it till the mid of Jan that we saw EOSS continuing from December?
Yeah, it did. In fact, it started a little early. So it started in the first fortnight of December and continued till third week of January. In fact, even post the formal EOSS got over, we had a few brands running or whatever, liquidating whatever was the tail of the stock left of EOSS. So formally it got over towards the end of the Jan, and last year has seen the largest EOSS on two counts. One is GST, so which a lot of stock got preponed into June, and June we started because obviously there was a transitioning from the pre-GST era in the month of June to July, and typically an EOSS which has been ranging between 55 to 62 days in the country went up to 74 days in quarter 1, quarter 2. And this EOSS period went for about 54 to 56 days. So overall, if you see, it has been a prolonged EOSS and the highest number of EOSS days it has seen, largely I would say on account of GST, but also an extended period in December, because there was some switchover about GST credits, whether they will come through on 31st December and whether the carry forward stock will have the input credit benefit. And that's why the EOSS started a little early in the liquidation, but it went on till January. That's what it was.
Sure. So if I just look at Q4, we've seen obviously 30 days of discounting, and I think the same quarter last year, that would have only been, say, max 10 to 15 days. So despite, say, the higher discounting, and even if I factor in the lower ad expenses, we've still seen an increase in margin significantly.
That's right. You're right. Yeah.
Okay.
Yeah, so there is a 6.5% margin improvement if you see. And the overall discounting has been held up because if you see our gross margin, it's broadly similar in Q4 last year and Q4 this year, but the minus 3% EBITDA has become a plus 3.7% EBITDA. So it's a 670 basis point shift, largely on account of one, as I have been maintaining in the last many quarters that as the scale keeps going up, the fixed costs don't go up in the same motion, so there is a better amortization of fixed costs. Plus, we have started getting a little more bang for our discretionary investments, which I think Sanjay made a point in opening statement saying our discretionary spends also start giving us a higher elasticity to our sales. So I think combination of both these factors led to a dramatic improvement in, or a fairly significant improvement, I would say, in EBITDA. Those absolutes are still, I would say, lower than our expected numbers for 2020.
Absolutely. Now, just continuing on the brand-wise growth, we obviously see that Raymond is doing really well. Specifically on Park Avenue, you did mention what the plan is going ahead, but is this more of a category issue where Park Avenue is more focused towards formal and that has been a bit of a lower growth segment? That is why you've seen this issue happening?
No, I would not say that because even Raymond has got a strong rootings to formal segment. So while Raymond is growing by 33%, Park Avenue, if you see just last year has grown by 7%, but if you see the last 3 years, all the brands have grown very, very strong double digit there. So Park Avenue CAGR in the last 3 to 4 years would be 13 to 14%.
Okay.
And so I would say that it's as I just given a sense of saying, as we're changing now, repositioning the whole product portfolio of Park Avenue along with the retail, that really is leading to a little bit of a comparison coming to a little lower growth. But overall, within these segments, if you see Park Avenue, we will see a much higher growth segments also inside there.
And possible for us to say the like-to-like growth for all these brands for the last year?
Like-to-like same-store sales? Or
yeah, same-store sales.
Only because the stores only contribute to part of the total sale, because so sales go through multiple channels. But the exclusive brand outlet, there, Park Avenue was 0.5% same-store sales. Parks was 6%. Raymond was 10% same-store sales. Color Plus was minus 0.7%. Made to Measure was 16%, and Raymond shops were 8%. So overall, a blended level, exclusive brand outlet, same-store sales growth was 8% for the company.
Sure. So just one last question. Other than Raymond Ethnic, is there any other product or extension that we are looking, or category extension that we are planning in the coming year?
I just mentioned, I think Khadi is another one.
I'm talking about Khadi and Raymond. That happened last year. I'm just talking of the coming years or future plans.
Yeah, so there will be extensions across all the segments. For example, in Made to Measure, 2 new categories are coming in. We are starting with denim Made to Measure now. So you can get your jeans made to measure. We are also starting with casual wear Made to Measure. So we can get a lounge wear or a casual wear also getting Made to Measure. T-shirts or your tracks, those kind of things are also getting in added there. So there are the 2 new segments getting in there. In our branded apparel segment, we're getting more and more, and we're introducing athleisure in a big way. So there is already in Park segment, you will see a strong introduction of athleisure coming during the year. That's an added segment which is coming, and we believe it could be as big as 15 to 20% of our revenue of the brand. So that's coming in a big way there. And so on and so forth. Individual segments have, for example, the chino segment is expanding both into washed, unwashed categories in a very big way. In denims, we are getting into stretch that you've not seen, in 15 to 18% kind of stretch proportions for denim. So there are in-house innovation. There are some new segments, like you said, Khadi and ethnics there. And there are some, sub-segments that we are also getting into.
Okay, sure. Just last thing, Ethnic and Khadi, how much revenues are we targeting for the coming year?
So we can't give you specific guidance there. Both of them are very new right now. They are just about getting introduced. As Sanjay said, that it's a year where we will scale up next look and we'll build Khadi. Yeah, so it's a year of build. So whether it is, a few crores to a larger, depends totally on whether we are able to reasonably crack the business model right from sourcing to distribution during the course of year. So I think next year, revenues will, as a guidance, will not be, it will be inappropriate for me to give you at this point of time, but maybe towards the end of next year or same time next year when we are having call after having done introduction and learning, I think we'll be in a better position to give you specific guidance on revenue.
Thank you. We take the next question from the line of Shivam Vashi from Alpha Alternate. Please go ahead.
Yeah, good evening, sir. So first question is regarding branded textiles. So there is you said the margin growth is largely accounted on account of strong sales growth. Is it because of realization improvement, and what has been the realization improvement for the quarter then?
Yeah, so overall, if you see the branded textile as a segment, overall it has grown. In Q4, if you're looking at, it's grown by close to about 15%. Yeah, or right. And that's really half in volume and half in realization. Okay. 7% is volume growth and about 7% is your ASP growth, which is the average selling price, the realization growth. That's also on account of mix there, because as we go, this Q4 has had a reasonable amount of weddings, and last year, it was still having some lag effect of demonetization.
Right.
So to some extent, this growth has to be seen more in a little longer period there. So if I now look at the full year picture for you in branded textile, the growth that Sanjay had mentioned in his opening is 10%. That's largely volume-led growth. So it's a 7% volume and a 3% realization-led growth.
For throughout the year?
Overall textiles, yes. Throughout the year. That's right.
Okay. And so what is your realization, approx realization in the suiting segment, in suiting fabric segment for the quarter? How?
So what do you mean by realization? You want
per meter fabric realization?
Yeah, so it's about 550 rupees. So that's the known number, close to that. Yeah.
Okay. And on the working capital days, so where do we stand on the textile on working capital days?
It's pretty well controlled. It's under about 25-26% of revenue. That's where we have been in terms of our working capital. And overall working capital has come down, as we said, as a group level, if you see console level, has come down from 99 to 87 days. So in suitings, it's come down to 22.6% of revenue. So it's very well managed.
Yeah. But so if you can just give me any number as to on days, how much?
So it's come down from 99 days. Suiting, specifically it's about 85.
Suiting has come down from 99 to 85.
Okay, from 99 to 85. Yeah. Okay. Thank you so much.
Okay, thank you.
Thank you. Next question is from the line of Dhruv Agarwal from Cressida Investment.
Yeah, good evening, sir. So my question is regarding the khadi business. What has been your total capital expenditure into this business as on date?
Nil. There's no capital expenditure. It's only working capital investment. We don't have any in-house production. It's 100% outsourced. It's sourced from KVIC. KVIC is the intermediary sales agent of khadi in India and abroad. It's the owner of this brand. So we have a deal with them to really procure khadi from them. We cannot set up our own technology at all, or our own infrastructure at all. And right now we have no investment in retail because we've not really established an exclusive retail for it. So at this point of time, no capital expenditure on khadi.
Okay, so you just outsource khadi from them and you then design as per your requirements or whatever designs are.
You're right. It's a trading business where we work with their artisans. We do our designs. We procure it from them and then we sell it in the market. That's what it is.
Okay. So for FY17, your denim revenues, if I'm not wrong, were around 875 crores. So what has been the denim revenue specifically for FY18?
See, there has been some improvement on account of revenues overall.
Okay.
Just give the number.
Yeah, it is about 950 crores.
950 crores. And if you can tell me EBITDA amount in crores or the EBITDA percentage for it?
We don't share the EBITDA percentages normally for this business.
Okay, but are you seeing sustainable EBITDA margins in the denim business, and how is the denim industry as a whole doing in the textile space?
See, the denim business is obviously dependent, very commodity driven by what happens on cotton. And there are two factors which have impacted this business. One is that cotton prices have not seen a decline with the new season crop. Cotton prices have remained firm for the last now 1.5 years, and we still have to see whether they will, they will soften this year. The second thing which is impacting the business is the capacity addition which has happened both domestic as well as in the continent, sub-Asian continent here. which is in Bangladesh and Pakistan, there has been a lot of denim capacity addition. Okay. So this business is seeing, on one hand, a little bit of contraction in demand, and the other is that the capacity expansion has gone up significantly. So there are challenges which are there. However, having said that, the business in 17-18 has performed for us exceedingly well because it's reversed from a loss that we had. It's reduced the loss by 25 crores from the previous year. So there's been in spite of these challenges, the business has performed well. It got impacted by 25 crores due to the currency appreciation that was witnessed in 17-18. And this impacted the revenue by 25 crores. So if this 25 crores, when we look at now 18-19, the situation looks much better. Denim is largely an export dependent business. So there is a positive uptick that we see. The focus has been in denim is largely driven on product innovation there and on garmenting solutions. And I think that strategy has helped the business to at least tide over some of the challenges which are there in the sector.
Right. So your denim sales are more of B2C or B2B?
No, all B2B businesses.
B2B. Okay, sir. Thank you so much. Thanks.
Thank you. We take the next question from the line of Sainik Pal, individual investor.
Last two.
Yeah. Thank you. Thank you for the opportunity, sir. Sir, can you give me the capex breakup for FY19 across segments?
He's given you the overall breakup of capex. He had said that overall about 250 crores of capex, which will be there, primarily driven by about 46 crores is a spillover from Amravati and Ethiopia. We have an apparel expansion rollout plan that we have about 40 crores. 48 crores will be in the new capacity addition that we are planning for the auto business. And the rest will be really maintenance capex across our plants.
Yeah. So, and what will be the net debt outlook for FY19?
So, net debt that we see, as far as the overall 250 crores of capex is concerned, we feel that largely it will be funded through internal accruals. At least 80% of that we feel will be funded by internal accruals. Our net debt levels will see an increase because of the investments that we will now be making in our real estate projects. So that we are still working out the numbers in terms of quarter-wise, how will it pan out, and we'll come back to you in terms of the actual impact that we see depending on how the project will be phased out during the year.
Okay. And sir, what is the current capacity utilization at Ethiopia and Amravati?
Amravati is just got commercial, so it's about 85% plus already. And Ethiopia is running at about close to 50% right now.
Okay. And so by when can it run at 100%?
It doesn't run at 100%. Well, if you look at theoretically, it cannot run at 100%. So they typically, garmenting factories are fully utilized when they start running at close to 70%, and fabric factories are fully utilized running at about 90%. I'm talking about theoretical capacity, okay? So, out of theoretical. So, 90% are fully utilized. So, I think Amravati is already probably weeks away from reaching there. And Ethiopia, because garmenting is a very different skill and a completely new workforce in Africa, we could take about 2 more quarters to reach there.
Okay. And so I see the inventories that have gone up on a year-on-year basis. Why is that?
So inventory has come down in number of days.
Yeah.
Is there a specific segment that you are referring to?
You will see that inventory because we probably, you've added the 105 crores which we've added to inventory, which is really the real estate project cost, which is technically classified as stock in trade.
Okay. Okay. Thank you. That will be all. Thank you.
Thank you. We take the next question from the line of Keval Shah, individual investor. Please go ahead.
Hi, thank you for the opportunity. So my first question is regarding branded apparel. Sir, in that category, with respect to the sales of our
Hello? Hello? Hello?
So just give me a minute. Just unmute. Mr. Keval Shah?
Hello, can you hear me?
Yes, please proceed.
Yeah, please proceed.
Yeah. Sir, my first question is regarding branded apparels. Sir, in that category, regarding the sale of accessories, can you just elaborate on what is the percentage of total sales and absolute value in terms of sales? And what was the historical year-on-year growth and outlook for it?
So currently, the total accessories would be close to about 6 to 7% of our apparel portfolio. And they have been growing at anywhere between 20 to 25% CAGR over the last 3 years.
Okay. And sir, any outlook for future guidance for that?
I would say pretty much a little higher than the overall. So if our overall guidance on apparel sales has been high, kind of middle double digits, so 15 to 18%. I think this would be about a 5 percentage points ahead of the median of the apparel sales growth.
Okay. Sir, my second question is a bit generic. Sir, if I say historically from 2011 to 16, our consolidated revenues have grown at, say, around 11%. Yes. And right now you gave us some revenue guidance of 7 to 9%. So mainly my question is, after taking all the initiatives of Khadi, ethnics, retail, network penetration, etc., why are we struggling to at least maintain the revenue growth of historical, what it was, around 11%?
No, in fact, apparel, if you see, 2010 to 2000, it's rare you take a cut. Yeah, it's really about that. And 2010 to 2014, there is no growth in apparel business. It's pretty much
console level, I'm saying.
At a console level. So console level, the base has also gone up significantly, and it's also a mix factor that happens. So the base is, if you take that compounded rate growth, the revenues are 2.5 times they were. I mean, with the diverse businesses that we have, it will be difficult to sort of continue to say that we'll grow 11% at a console level year on year. I think we'll have to look at business segment-wise as a strategy for each business. Also, it's a strategic portfolio call you take in terms of trading off, part of operating margin. Yeah, like tools and hardware, we have specifically now said that we'll not chase revenue, but we'll chase profitability and return on capital employed there.
Okay. Sir, and what is the outlook on net working capital days or inventory days going forward?
Yeah, so
will it continue to decrease?
We've seen a reduction about 12% because from about 99 to 10 days reduction in NWC. Now the focus NWC is a key focus area for each of our businesses, and I think that will remain. The initiatives which we have on supply chain, there are specific set of initiatives which are driving the businesses in branded textile and branded apparel, the core businesses. And these initiatives are likely to focus a lot on better inventory turns and inventory management, and specifically in apparel, trying to reduce the number of the end of season inventory. So I think these are the initiatives which will continue to be there.
Okay. Sir, and regarding our real estate, so you mentioned a 3 million square feet of saleable area is there. Can you comment on what would be the carpet area roughly?
No, I won't be able to tell you that. As I said that, there are specific details which we will come back to you very soon. So we'll have to just request you to be a bit more patient. I mean, the teams are post the board approvals are working feverishly to put everything together. So we will come back to you soon with the specific information that you are seeking.
Sure, thank you.
Thank you very much.
Well, that seemed to be the last question. I now hand the floor back to the management for their closing comments.
Thank you. I would like to thank all the participants for taking your time and attending the earnings call today. You can call or you can mail us for any further queries. Thanks again. Good evening.
Thank you very much.